What if I told you that two investors could start with the exact same $100,000 in 2026? And 10 years later, one is collecting a modest side income, while the other is generating a serious passive income stream capable of paying monthly bills indefinitely? The difference is not luck, it is not market timing, and it is definitely not chasing speculative growth stocks. The difference is the structure of the income strategy itself. Because right now, millions of investors are quietly shifting away from volatile market hype and towards something far more powerful: cash-producing assets. Assets designed to generate income whether the market is euphoric or collapsing. And two names dominate that conversation in 2026. SCHD, the Dividend Growth ETF that many investors now consider the ultimate compounding machine. And Realty Income, the REIT empire famous for paying shareholders every single month. But here's where things become extremely interesting. One of these strategies may create substantially higher long-term wealth through dividend growth and compounding. The other may produce dramatically stronger cash flow immediately. And choosing the wrong one for your financial objective could cost you hundreds of thousands of dollars in future income over the next decade. So today, we're breaking down the exact numbers, the dividend growth rates, the payout sustainability, the yield on cost projections, and the hidden risks Wall Street rarely explains clearly. Because by the end of this video, you'll know which passive income strategy may actually deserve your capital in 2026. After years dominated by speculative technology valuations, 2026 has become a turning point for income-focused investors. Interest rates remain structurally elevated compared to the ultra-cheap money era of the early 2020s. Market volatility continues to punish weak balance sheets. And suddenly, predictable cash distributions matter again. This is exactly why dividend growth investing is experiencing renewed momentum. Not because dividend investors expect explosive overnight returns, but because compounding income creates resilience. SCHD represents one side of this philosophy perfectly. The ETF focuses on financially healthy U.S. companies with strong dividend histories, sustainable payout ratios, and robust free cash flow generation. Its current dividend yield remains highly competitive for a broad dividend ETF. Meanwhile, its 5-year dividend CAGR has consistently outpaced inflation over long periods. Realty Income takes a completely different approach. Instead of diversified exposure across sectors, investors gain direct exposure to commercial real estate cash flow. The company owns thousands of properties under long-term triple-net lease agreements, creating highly stable recurring rental income. And most importantly, Realty Income pays dividends monthly. That psychological effect matters more than many investors realize. Monthly cash flow creates the feeling of a real passive income stream, not just portfolio appreciation on a screen. The investment landscape has shifted. We're moving beyond speculative tech towards income-generating assets. Dividend growth investing offers true resilience. Compounding income builds wealth steadily. We'll explore two approaches: SCHD for diversified, healthy companies, and Realty Income for direct commercial real estate exposure. Realty Income offers monthly dividends, providing a powerful psychological impact from regular cash flow. Let's begin with SCHD. The ETF has become one of the most respected dividend growth vehicles in the United States market. Why? Because SCHD is not simply chasing high yield. It prioritizes quality. The portfolio screens for companies with strong return on equity, sustainable dividend payments, durable competitive moats, and healthy balance sheets. Its holdings include many dividend kings and dividend aristocrats, companies that survived multiple recessions while continuing to raise shareholder payouts. Key metrics remain impressive. Ticker SCHD. Dividend yield, approximately 3.5%. 5-year dividend CAGR, roughly 11%. Expense ratio, extremely low, one of the ETF's greatest structural advantages. Payout sustainability remains attractive because the underlying companies generate substantial free cash flow. This creates an important long-term advantage. Dividend growth. Because over time, growing dividends can become dramatically more powerful than starting yield alone, especially during inflationary periods. And unlike concentrated REIT exposure, SCHD provides sector diversification across industrials, healthcare, energy, consumer staples, and financials. That diversification reduces single industry risk while maintaining exposure to mature cash-generating businesses. For investors seeking scalable compounding over decades, SCHD behaves almost like an automated dividend growth machine. Now let's examine Realty Income, ticker O, one of the most iconic income-producing REITs ever created. Realty Income's strategy is remarkably simple. Acquire high-quality commercial properties, lease them under long-term triple-net agreements, and distribute the resulting rental cash flow to shareholders every single month. That consistency has become legendary among passive income investors. The company has paid hundreds of consecutive monthly dividends and increased its payout repeatedly across economic cycles. Current metrics remain highly attractive for income-focused portfolios. Dividend yield approximately 5.5%. 5-year dividend growth rate around 4% annually. Payout ratio significantly higher than SCHD, which is expected for REIT structures. And that introduces the core trade-off. Higher immediate income, but slower long-term dividend growth. Still, Realty Income possesses several strengths that continue attracting investors in 2026. Its tenant diversification is massive, its occupancy rates remain historically resilient, and its real estate portfolio acts as a partial inflation hedge due to rent escalation structures embedded inside many contracts. For retirees or investors prioritizing immediate passive income, Realty Income creates a very different psychological experience compared to SCHD. Because monthly distributions feel tangible, like receiving rent checks from a large-scale commercial real estate empire, without directly managing properties yourself. Now comes the most important section: projection. Let's assume a hypothetical long-term investor allocates $100,000 into each strategy and reinvests all dividends. SCHD begins with a lower starting yield, but significantly stronger dividend growth. Realty Income starts with much higher immediate income, but slower compounding. Over a 10-year horizon, SCHD's dividend growth engine could potentially produce dramatically higher yield on cost, especially if dividend CAGR remains near historical levels. This is the hidden power of dividend growth investing. Compounding eventually dominates starting yield. However, Realty Income may still generate superior cumulative cash flow during the earlier years of the investment lifecycle. That matters for investors already living off portfolio income today. So the answer depends heavily on investor objectives. Do you prioritize maximum future income growth or maximum present-day cash flow? Because these are fundamentally different portfolio strategies, and sophisticated investors often combine both. SCHD for long-term compounding, Realty Income for immediate monthly income stabilization. But no passive income strategy is risk-free. And this is where many YouTube finance channels become dangerously simplistic. SCHD faces valuation risk. If dividend ETFs become overcrowded, future returns may compress significantly. Its performance also depends heavily on the health of mature U.S. corporations and broader economic profitability. Meanwhile, Realty Income carries different structural risks. Interest rates matter enormously for REIT valuations. If borrowing costs remain elevated longer than expected, REIT expansion becomes more expensive. And while Realty Income is widely respected, investors must remember one critical fact: high yield alone does not guarantee superior total returns. This is where dividend traps emerge. Sophisticated dividend investors focus not only on yield, because ultimately, a dividend is only as strong as the underlying business supporting it. So, which passive income strategy wins in 2026? For long-term dividend growth and compounding efficiency, SCHD may offer the stronger total return profile. Its exposure to dividend aristocrats, lower expense ratio, and higher dividend growth rate create a powerful long-duration compounding engine. But for investors prioritizing immediate cash flow and monthly income predictability, Realty Income remains one of the most compelling REIT income vehicles ever built. And perhaps the most sophisticated answer is this: the real winner may not be SCHD or Realty Income individually, but the strategic combination of both. One optimized for future income expansion, the other optimized for present-day passive cash generation. Now we want to hear your perspective. If you had $100,000 to deploy today, would you choose SCHD, Realty Income, or both? Write your answer in the comments below. And if you enjoy institutional quality dividend investing analysis focused on compounding wealth and premium passive income strategies, subscribe to our channel. This content is for informational and educational purposes only and does not constitute financial advice. Always conduct your own due diligence before making investment decisions.